Hi, hello, good morning, my young officers. Welcome to this new course called as Complete Course on Indian Economy for your upcoming UPSC Prelims as well as Mains Examination. So this is Nisha Nujumudeen, your educator at Unacademy. So now, today in this particular course, we'll be discussing Chapter-4, Part-3, which deals with monetary policy. So for the past 2 days, we have been discussing regarding money, then the evolution of that, then we spoke about the monetary policy for our country, India, with regard to the Monetary Policy Committee and all. So now today we'll be dealing with another part of monetary policy which talks about the instruments. How does the RBI, they literally use the instrument called as monetary policy to control the credit in the entire economy. Okay, so in a detailed format we'll be studying. And now before that, as you all know, this is my Nisha Nujumudeen, one of the top plus educator at Unacademy. This is my Unacademy profile. So now to follow me for all the free classes and the plus classes, very simple. Go to Unacademy, open this profile. You will be finding all my plus courses. Currently, I am doing a course on daily current affairs for both prelims and mains examination in the plus platform at 9 p.m. wherein we will be affairs in note format from every sources, the Hindu, the PIB, the Indian Express, the Deccan Chronicle, etc., etc., which are very, very important for the UPSC perspective, including the editorials plus, categorizing each topics as to what is important for prelims and mains examination and giving you like a note format. Along with daily MCQs and answer writing practice, you'll be getting it there. So it's a holistic course, don't miss it. Apart from that, I'll be studying again a complete intereconomy course. It will be even more, wider than what we're doing right now in YouTube. That is also in the Plus platform, which starts on October 29th and will continue till December, 31st. Apart from that, the free classes currently, if you see at 9:30 examination every day, Monday to Friday, 9:30 a.m. after this YouTube class, we'll be doing top 500 question answer practice for mains. So today you have at 9:30 a.m. this mains answer writing course, guys. It is a free class. The link of that is given in the description box of this particular video. Apart from that, 6 p.m. daily, you will be having top 2,500 MCQ series. You can just go. Perfect. Guys, is the audio, video, everything visible? Okay, perfect, Amanda. Okay, done. So yes, as we all know, what is monetary policy? Policy of RBI, right? In order to control the money supply. So now the next question is, how will you control the money supply in the economy? What are the things that RBI does using this monetary policy or credit control instruments? What does RBI do literally to control it? That is the next question, right? So in this particular class, we are going to see in detail as to how RBI is controlling the money supply using the various credit control instruments, etc., in detail. And now in this particular class, guys, the concepts covered will include monetary policy tools and money supply in India, along with the monetary policy agreement also for our country, India. So now the whole point here is in yesterday's newspaper. Okay, I am going to connect this basic concepts to yesterday's newspaper as well. If you see in the editorials, you would have come across a topic called as Monetary Policy Committee recommendations. Remember, I think in the plus class I taught you all. Those who are on the plus platform will know it. So now the editorial consists of monetary policy committee recommendations, the new recommendations taking into consideration the COVID-19 pandemic. Okay, they said that hereafter they will not change the interest rate. In yesterday's YouTube class, remember, we discussed regarding what are the measures taken by RBI with regard to interest rate. There is something called as expansionary and contractionary monetary policy. The interest rate will be increasing when there is contraction, and the interest rate will be decreasing when there is expansion. That is how monetary policy applies its tools to control credit. But now, if as per the recent current affairs, guys, what is RBI doing? RBI using the instrument called as monetary policy. In the monetary policy committee, what did they do? They said that hereafter they are going to keep the interest rate unchanged. matlab stable. So now it gives a shock to the entire economy scenario, because why would RBI do that? Why would the Monetary Policy Committee decide that? There is a reason for that, because of this COVID-19 pandemic. We all know that the objective of monetary policy is what? Achieving growth with stability. I repeat, achieving growth with stability. So now taking such actions because of the effects of supply shocks in the economy to restore that and to help the economy to come back to their normalcy. And also they have adopted a stance, STNC, stance called as accommodative stance. What is accommodative stance? Accommodative stance means cutting the rates like your repo rate, bank rate, interest rate, etc. to help money injected, or to make sure that yes, the money is flowing in the economy. There is liquidity of money in the economy, thereby increasing the money supply, because currently we lack that money supply in the economy, right? Which is hampering the activities. So, in order to prevent that and boost the economy back to normalcy only, RBI has said that, come on, in the Monetary Policy Committee, these recommendations have been kept forward. Clear? This is a very recent current affairs from yesterday's newspaper. If you want to understand regarding this in detail, you need to have a thorough understanding as to what are the instruments used by RBI under the monetary policy to control this, inflations and other scenarios. So, in this particular lesson, guys, the basics lessons, we'll be discussing as to what are the tools of monetary policy. Clear? Those who have missed my previous classes, you can watch the playback or recordings and also connect them with the current affairs. It will be useful for you to a greater extent. Clear? And this is very important from the prelims as well as mains perspective, this particular topics of monetary policies. Fine? Perfect. So yes, here it goes, guys. We are going to talk about the RBI tools. What are the tools? Matlab, the instruments of credit control or money supply which is put forward by whom, guys? By the central bank of a country. Probably if you see, in a broader perspective, there are two methods of controlling credit. What are they? Quantitative and qualitative. So now you are learning all these things. Why, guys? Because individually from the static portion you can get question. But mostly in economy, for the prelims perspective, from the static plus the current affairs perspective of all these instruments like your repo rate, reverse repo rate, cash reserve ratio, etc., you can get questions. For the current October 2020 prelims also, as I predicted, guys, in the MCQ classes, you had a question based on CRR, SLR, MSF. Remember? So, which means that this is one of the hit list topic of UPSC prelims as well as mains examination. And now connect this to the current affairs perspective. After going through this class, get back to your previous day's newspaper, go through the editorials based on monetary policy, you will be able to understand them with much of ease. Clear? So now, back to basics. Talking about the quantitative method of control. So thus, what is quantitative, guys? As we all know, quantitative means what? They are instruments which are designed to regulate the volume or the amount of credit which is credited by whom? The banking system. Whereas qualitative, now they are also called as selective methods. Basically, they are designed for what? To regulate the flow of credit in particular uses. So now quantitative is important or qualitative instrument is important? Actually, both are equally important by the RBI. But if you see, RBI always prefers quantitative instruments than the qualitative perspective. The reason is because quantitative is the instruments which is widely accepted or used by RBI for controlling the money supply in the economy. Because these quantitative, guys, it talks about the entire volume or amount of money or credit, guys, which has been created by the entire banking system. Whereas qualitative talks about your moral suasion and methods like that. For one particular purpose, you'll be applying it. You understand? So that is why your quantitative ranks a higher position compared to the qualitative measures. Clear? Also, when you study or also when you see the questions in the UPSC paper, most of the questions are based on the first method. That is quantitative method of credit control. Clear? Like your CRR, SLR, repo rate, etc., etc. Yes, Alok, ma'am, आप हिंदी में class क्यों नहीं लेती? Alok, I'm a South Indian faculty. I do take class only in English. मैं थोड़ा हिंदी मालूम. But to take a class, I'm more comfortable in this language. You can follow me for any doubts. Okay, I am using only very simple English, not that bada wala English, so it will be easy for you. So yes, what about the others? Yes, Lipsy, good morning. So very fine. Shall we go to the next slide? Okay. So now, these quantitative methods, as I told you, they are also called as what? Traditional methods. And what are the different quantitative instruments? Your bank rate or discounting the bills of exchange or interest rate. That is a very first important traditional or let's say quantitative instrument of credit control. In connecting this to the current affairs scenario, guys, this basics. If you see again in the recent current affairs newspaper, you would have seen how RBI using the Monetary Policy Committee, they are focusing on this quantitative or traditional method called as interest rate. Matlab they're keeping it unchanged or stable. That is the current affairs perspective of this particular topic. So along with your bank rate, also called as discounting the bills of exchange and interest rate, you have another quantitative instrument called as OMO. What is that? Open market operations, followed by variable reserve ratio. This can be categorized into cash reserve ratio, statutory liquidity ratio, SLR, CRR, then repo rate and reverse repo rate. Apart from that, there are some more extra reserve ratios like your MSF. What is that? Marginal standing facility, liquidity ratio, etc., which I'll be discussing with you in detail. Clear? Now similarly, like your traditional or quantitative method, the qualitative are what? The selective methods. Now they basically they are the methods of controlling money or credit based on regulation of what? Regulation of margin requirement. Then the methods include selective like moral suasion, credit rationing or rationing of credit, regulation of consumer credit, and direct action. So all these things comes under what? They comes under your qualitative methods or selective methods. Clear? Any doubt? Did you understand what are the methods? These are very, very important. You have to categorize the methods, quantitative and qualitative, into two different categories, and understand the importance of these for you to focus on each of these methods individually. Perfect. So yes guys, we are going to see in detail the quantitative method. So now before that, I hope all of you know what are the functions of RBI. Now the functions of RBI is what? They are the monetary authority and they are the regulator and supervisor of the entire financial system. They are also the regulator and supervisor of the entire payment system. They are actually a manager of foreign exchange, issuer of currency, they are a banker to a bank. They are the ones who literally control the entire commercial banks and all, right? So go through all those perspectives because they are actually the most important points to be noted to understand the importance of RBI. Okay. So now talking about the quantitative instruments of credit control, the very first one you have is what? It is the bank rate policy, or in simple terms called as discounting the bills of exchange. I repeat, discounting the bills of exchange. So now how will you literally apply this practically? Now, bank rate policy, in simple terms, think about interest. In one word, think about interest. That is what your bank rate policy talks about. So the first quantitative tools of monetary policy is your bank rate policy or interest rate. They are the minimum rate. How do you define that? The minimum rate. The key word is that. And the rate at which the central bank of a country, that is RBI, is giving loans to whom, guys? Is giving loans to all the commercial banks of our country, like your State Bank, your Canara Bank, your Punjab National Bank, etc., etc. So whenever RBI is giving a loan to all these commercial banks at the very minimal rate of interest, that is called as bank rate, or in other terms, discounting the bills of exchange. That is why this bank rate is also called as interest rate and also the discount rate, because the central bank is giving some money now, or let's say finance to whom, guys? To these commercial banks, and they're giving it at a low rate. That is why it is called as rediscounting the bills of exchange. Clear? And thus, why does RBI use bank rate, guys? Basically, this policy of bank rate is used by the RBI to control the money supply or credit in the economy. Now, for example, let's take the case of inflation. Based on this, you may get application level questions also for your prelims. You all know inflation. Basically, to control the money supply and to control inflation only, guys, such kind of tools are used by RBI in practicality, right? Now, what is inflation? As you all know, the consistent or the persistent rise in general price level. There is an inflation scenario. Now, what will RBI do? RBI has to play an important role, right? With regard to the instrument called as bank rate, what they will do is, will they increase or decrease? Now, bank rate means the minimum rate. Matlab, the lowest rate in which RBI is giving loans. So now, during an inflation situation, too much of money supply is there in the economy, right? That is why inflation is put forward, where the prices are increasing for all the commodities. Taking the scenario into consideration, the RBI will increase the bank rate. This minimum rate, for example, if it is 5%, RBI will make it 10%. Because there is inflation in the economy. You understand? Automatically what happens, RBI is giving money to commercial banks. They are borrowing and they are paying the interest. Now, the cost of borrowings for all these commercial banks, like your state banks, your commercial Canara Bank, all these banks, now it becomes costlier for them. Yes, Amanda, yes. It increased. And somebody called hi as well. Yeah, it increased. Wonderful. So now, it becomes very costly for them because from 5% it increased to 10%. You understand? Automatically what happens, for example, when the interest is 5%, we are tempted to borrow because less interest. But now from 5% it jumps to 10%. Will you prefer for a loan? You may think, why would I pay that extra 5%? It is a burden for us, right? Similarly, from the bank's perspective also, what happens? Yes, the cost of borrowings for commercial banks, that will increase, which will discourage this commercial banks guys from borrowing from whom? From the RBI. Hence, what happens if this is a scenario when there is no borrowing from the from RBI with the commercial bank? What happens? We the people, like the investors, the agriculturalists, the other industrial people and all, we cannot go and get a loan. Commercial bank only should give us money now, and commercial banks gets money from RBI. RBI does not have a direct contact with general public, whereas commercial bank do has. But when this scenario is happening, automatically the lending in the economy will fall down, along with increase in what? The lending rates or interest rates of the commercial banks. Automatically increase in lending or interest rate will discourage investment, because we are not going to borrow, take loans from banks. So where will we go for money for the investment? That will also decrease, and automatically the total demand, or let's say aggregate demand, that also will decrease. This is what happens when the RBI increases the bank rate. What about the scenario guys when RBI decreases bank rate? The ulta. Now, increasing bank rate by RBI will reduce the interest rate and discourage the investments and borrowings of commercial banks. Whereas in decreasing the bank rate by RBI is the ulta thing. Whereas more and more borrowings will be encouraged, more and more investments will be there, and the interest rate when it's reduced means the money supply will be too much. You understand? And thus a fall in aggregate demand guys in this particular context will automatically lead to reduce in income and output in the economy. Thus inflation. Through this, they will try to subsidize and normalize inflation. Yes, Sandeep, you are perfectly correct. Sandeep is saying that current inflation rate crosses 7%. Very true. That is what I said to you initially in the beginning of the class. This is very, very important from the current affairs scenario. Based on this interest rate, in yesterday's editorial, we had a topic based on Monetary Policy Committee. There, they are saying that they are going against the principle of Monetary Policy Committee with regard to what? Inflation targeting. What is inflation targeting, my young officers? Inflation targeting means the rate at which inflation is fixed. Since 2016 under Urjit Patel committee, we have been doing that. Now they said that inflation should be fixed at a rate of 4% with a band of plus or minus 2%. That is up to 6% they can be, but not more than that, and up to 2% they can reduce, but not below that. But currently, if you see in the month of August 2020, 6.68 was the inflation rate. In the month of September, it became 7% and currently 7.34%, which is way more than the targeting of inflation set by the economy, by the RBI. Actually, inflation is required for any economy to grow, but there is a level for that. But now it is too much. Why? Because of the COVID-19 pandemic. So now the RBI itself is outruling it. Matlab, they are going against their targeting by saying that it is okay to have a higher rate of inflation, and that is why they are keeping the bank rate constant or unstable. And the reason they gave is they will follow the accommodative stance. As I told you, what is accommodative stance? Cutting the rates of all the bank rate, repo rate, vagera stuff to make sure that the economy is back to track. There is money supply and boosting the economy. You understand? Connect this with your current affairs perspective. Study like that. So you will finish, you will be completing a static portion, and now from the static portion, once you understand that, connect that with the practical applicability, the current affairs perspective, which is very, very important. Clear? Did you understand, guys, now? I hope now if you go back to your editorials and read, it will be easy for you to understand the meaning of what is given in the newspaper, because we have covered the basics now. Clear? And RBI is actually supporting, saying that it's okay for this point of time to outrule this inflation targeting. And for the mains examination, they can ask you a question as to discuss the recent changes made by Monetary Policy Committee with regard to the interest rate, and they have literally made the inflation gone against the inflation targeting rates. What is your point of view on that? Critically analyze. So you can say, though there are advantage as well as disadvantage going forward with this thing, but RBI is saying that come on, it is okay to go with the new scenario with such kind of high interest inflation rate, because the economy demands it due to the supply side shocks. You understand? And the higher taxation perspectives and all. Clear? Yes, Alok, Sandeep. Yes. Where are the others? Now, the second important thing talks about what? The quantitative or the traditional method of credit control is open market operations, OMO. That is like one of the most important tools we all know, right? Now, what is the meaning of that? In simple terms, two keywords are associated with OMO. What is that? Purchase and sale, or buying and selling of what? Securities and government bonds by the central bank. Now, a scenario where the RBI will buy and sell the securities in the market is that, for example, again, when there is inflation, what they will do again? Too much of money supply. Automatically, the RBI will start selling the securities and bonds. So, when RBI is selling to whom, guys? Is selling to the market or to the public. So now when we purchase that from RBI, money is going from our hand. Simply RBI won't give you, right? Money goes from your hand. So automatically what happens? Slowly RBI is taking or sucking out all the money from the market to subsidize inflation. Now, when there is no money in the economy, a kind of deflation, or let's say lack of money supply, the economy activities are gone down. So now to boost the economy, RBI will use the instrument called as open market operation because it consists of purchase and sale. Now the RBI will start purchasing. When the RBI is purchasing, we are giving RBI. So automatically money is coming from RBI to the market. It has been injecting money. So now the supply of money in the economy increases. You understand? So this is how RBI uses the instrument called as open market operation to control the credit or money supply in the economy in very, very simple terms. Clear? Did you understand? In the context of inflation and also in the context of deflation, reduce money supply. But though this is the case also, if you see, there are certain limitations with regard to your open market operations. That is underdeveloped markets, securities market, then excess reserves with commercial banks, indebtedness of commercial bank, etc., etc. These are the limitations of your open market operations. Clear? And now one more thing, guys. During inflation, when RBI sells the government securities, money supply also reduces because for taking out all the extra money supply, RBI does that. What happens to your lending, guys? The lending of commercial banks, that also decreases. When there is a fall in lending by the commercial banks, automatically the money supply gets reduced in the economy. They contract the credit in the economy. Now the next one is CRR. Very, very important. This comes under what, guys? Actually, this comes under the reserve ratios. Now, under the variable reserve requirements or reserve ratios, you have the first one called as CRR or cash reserve ratio. Normally, the CRR is expected to be at the rate of 4%. But currently, guys, there have been a lot of fluctuations, right? It has become 3.5%, then 3%, because scenario is like that. And then there was a point of time when it was 5%, then ideal was 4%, but currently it has been decreased. And your statutory liquidity ratio, it was more than 21.5% before, then decreased to 18.5%. Again it has been increased to back to more than about 20% as per the current data. It is keeping on and on fluctuating because of this COVID-19 pandemic. So now in simple terms, what is reserve, guys? Reserve means what you have in hand. Cash reserve means what? Now in simple terms, cash reserve ratio is nothing but the amount of reserve which the commercial banks like your State Bank, Canara Bank, all these banks have to keep with the RBI. It is mandatory. So now for example, there are let's say 100 crore for State Bank, which is a commercial bank. Out of this, the cash reserve ratio is supposed to be 30%. So now the 30 crore will be taken and kept with RBI, guys, as a reserve. They will not take any money out of that. So remaining 70 crore only will be available with the SBI or the commercial banks to give it to the customers as a borrowing or etc. etc. Clear? Matlab to give it to the public via loans and all the prospectus. Suddenly, because of inflation, too much of money supply in the economy, RBI is increasing the reserve ratio from 30%. They said, come on, it should be 50%. So from 100 CR, they have to keep now 50 CR, right? Where, guys, as a reserve with the RBI, the commercial banks. So now what happens? Only 50 crore is available with the commercial banks. What happens to them now? Will they be able to give more money to the customers? Definitely no. First come first serve basis will be happening. That is, whoever is willing to willing to borrow the money, that too at a higher interest rate, will get it, because lending becomes costlier when the reserve ratios are increased by whom, guys? By the RBI, because less of money in the hands of commercial banks. So what will they do? They have to increase the lending rates. You understand? But now it becomes a burden for the consumers. We the consumers, or we the investors, or whoever who wants to get the money from the bank. You understand? This is how it works. Clear? For example, as I told you, if the RBI wants to increase the CRR from 10 to 20%, then they have to keep 200 as reserve against a deposit of 1000. So automatically the money supply will reduce and they will have less money to lend. Automatically borrowings become less because interest rate becomes costlier. So what happens to investment when there is lack of money? Now investment is also decreasing. Now your income and your total aggregate demand, that also decreases. Now when there is a reduction of cash reserve ratio, guys, from 10% to 5%, now things will be very much different. Automatically the lending capacity of commercial banks will increase because more of money is supplied in the economy. Automatically the ulta of what happened in increasing of CRR happens in reduction of CRR. Investments will increase, more money supply. Income will increase. Automatically aggregate demand will also increase. Please understand these scenarios. If you understand it like a connection, like an interconnection story, it becomes easier for you. Clear? Now, The next one is liquidity adjustment facility, guys. That is also one of the quantitative, or let's say the traditional tools of credit control or monetary policy. Now, under this facility called as LAF, that is liquidity adjustment facility, which is a monetary policy instrument, what do they say? They say that the commercial banks and all the primary dealers, okay, basically, why do they borrow money, guys? They basically borrow money. And now they do that through some repurchasing agreements. And that repurchasing agreement in simple terms is called as repo rate and reverse repo rate. So thus, using this arrangement called as liquidity adjustment facility, I can tell you that it allows the banks to respond to what the liquidity pressures, and this is also used by the governments to assure the basic stability in the entire financial markets. And thus the two important types of liquidity adjustment facilities are repo rate and reverse repo rate. Clear? And thus to adjust the day-to-day fluctuations in the liquidity, guys, this instrument is called as liquidity adjustment facility has been used. That is your repo rate and reverse repo rate. And now another important point is that the RBI, they extend such kind of facility only to commercial banks. I repeat, only to commercial banks. And now in that particular context, you have to note something. They exclude your regional rural banks. Okay? So thus this repo and reverse repo rate facility called as LAF, that has been extended by your RBI only to commercial banks and your primary dealers. They do not take into consideration your RRBs, your NBFCs, etc. etc. Clear? Now, this facility called as LAF, okay, they allow the bank for what, guys? To park their excess money or to store the excess money with RBI in case of excess money supply liquidity, or to get liquidity or money from the RBI at the time of deficit on an overnight basis, guys. And that too is in one night. How will you get such reserves or money? You have to submit some collateral. So then the collateral of government securities, when you give that, you will be getting money in such kind of scenarios. Clear? Now the two most important liquidity adjustment facilities are repo rate and reverse repo rate. What is repo rate, guys? Repo rate, also called as repurchasing agreement, the rate at which our commercial banks will borrow from RBI. That is called as repo rate. So repo means what? Repo in simple terms means repurchase options, and that is repurchase of government securities. Rate of interest, the RBI charges from the clients for the short-term borrowings. I repeat, short-term borrowings, to meet all the short-term requirements of the commercial banks only. They go for the repo rate. That is why they said that the rate at which the commercial banks will borrow from RBI for meeting their short-term needs of liquidity, and that too they'll do that against the selling of government securities with an agreement of what? Repurchasing the same government securities at one particular future date and one particular rate. It will all be fixed in that agreement. Clear? And thus the rate at which the RBI is lending to the commercial banks is called as repo rate. Very fine. And thus in simple terms, I can tell you that again this repo rate, that is actually similar to your bank rate, because they're also discounted rate. Okay, in more or less simple terms, I can tell you that. And when the repo rates are higher and lower, what happens? We'll see that after studying what is reverse repo rate. Now, before going to the scenarios, let's have a discussion as to what is reverse repo rate. The opposite. If repo rate is like the rate at which commercial bank is borrowing from RBI, what is reverse, guys? Reverse means the opposite, where the central authority, that is RBI, will be borrowing from all these commercial banks. That is, this facility allows the RBI, guys, to borrow from the commercial banks. That too, how can RBI do that? Simply can they do? No. They have to lend some government securities. That is called as reverse repo rate. Clear? And now, this so-called repo, guys, repo rate is actually injecting money into the system, because when our commercial bank is borrowing from RBI, they're getting money from RBI. So now commercial bank is having money in their hand, which they can give to their customers in the form of loans, vagera stuff, wherein investments will increase, aggregate demand will increase and all. So it is a way of injecting the money into the system or economy. Money supply increases. What about reverse repo rate? It's opposite. RBI is taking money from the banks, guys. Automatically, they is taking money out of the system. Supply of money reduces. You understand? Now, which are the scenarios in which RBI will increase the repo rate, guys? The scenario in which RBI will increase the repo rate is during inflation. And they will decrease repo rate again during deflation and low growth. Very simple logic. Increase repo rate in inflation, decrease in deflation and low growth. That's all. Clear? Yes, Prabhagar. Primary dealers means what? Primary dealers, your cooperative banks, your basic, dealers, which does not consist of your RRB. Apart from that, everything else, RBI can extend this facility called as repo rate and reverse repo rate. Yes, Lipsy, keyword only. Matlab? Yeah. Okay. Clear? So based on these keywords only, guys, you can get questions for your UPSC Prelims examination as well from these keywords under these topics. Clear? This is a very, very important hit list topic. I have been telling you this since the last 7 months for the upcoming for the main prelims examination. We saw that in the question paper also, right? You got all the questions in one match the following, not match the following, in one question, as to repo rate, reverse repo rate, MSF. Remember, go through the 6 p.m. class. In that you would have seen where I predicted all these questions. I've done so many questions also on the same topics. So even for the next prelims as well, guys, this is still an important topic. Now next prelims, mostly in the context of Monetary Policy Committee, there are chances for questions to come, because that is actually on the rise, and the contribution made by Monetary Policy Committee, guys, with regard to COVID and pandemic is highly notable. That is keeping the interest rate stable, unchanged in the context of accommodative stance, what I told you. So all these are kind of the important hit list topics in which questions can come. So kindly pay full attention to these courses, and also make a point of making notes and mind maps and studying this thoroughly. Clear? Perfect. Now what is that important point to remember, guys, with regard to the window of liquidity adjustment facility is that, see, this facility called as LAF, which consists of repo and reverse repo rate, they do not even allow the banks to borrow unlimited amount from RBI. Look at this, guys. Now no kallatram is allowed, no mischiefs are allowed. Unlimited amount it does not allow to borrow from RBI. Now, as per this facility called as repo and reverse repo rate facility, the banks can only borrow a limited percentage, and that too of something called as NDTL, that is net demand and time liabilities. Again, demand deposits and time deposits are also the hit list topics. I have told you this before. And for the current October 2020 prelims also, you got a question based on demand deposits. Remember, I taught you in the context of NBFCs. And I told you definitely you will be getting a question either from demand or time deposits. And yes, from time deposit, the practical applicability, like what happens when the money is withdrawn, will they increase money supply or not, in the context of example of 1 lakh that was there in the examination. So these are all hit list topics. Kindly go through. Clear? The measures of money supply, that is also a very, very important topic. Go through that. M1, M2, M3, M4 and all. Because based on this, UPSC can never ignore the monetary policy part of or banking part of economy, because they are very much relevant with the current scenario. So from the static and the current affairs perspective, they want to test whether the student is actually updated. That is why this area is always considered as a hit list area, where every year you can expect some questions from this part of economy. And it has been happening also. So this year, as I told you, you got repo, reverse repo, MSF and all. Previous year it was CRR, SLR. Again, we could we could literally predict the same thing. And the coming year again, in the context of MPC, Monetary Policy Committees, along with these instruments, they can ask with regard to even your open market operations, your bank rate. In those contexts as well, you can get questions. Take care. So pay attention right from now onwards for your examination. And for the mains perspective, again, from the current affairs perspective, as of now till today, regarding the recommendations made by Monetary Policy Committee with regard to the interest rate cut perspective, why they are keeping it unchanged, like that you can get a question. Clear? Okay. Now the next one is marginal standing facility. Come on, this is somewhat similar, guys, to your repo rate, because people get confused with MSF and repo rate, thinking that both are the same thing. But no, it's not the same thing. Repo rate and MSF rate is what? It's a rate at which the RBI borrows from commercial banks borrow from RBI. But now, if you see in the year 2011-12 only, this facility or scheme called as marginal standing facility was announced by the central bank of our country, RBI. And what is MSF, guys? They are the penal rate. I repeat, penal rate at which the commercial banks can borrow money from RBI. And now they can do that just like the repo rate, guys. Same thing. Repo rate also commercial banks borrow from RBI. But now there is a time for that. If supposing I'm a state bank holder, okay. I'm SBI and I'm going to RBI and saying, come on, we need money. So now simply like that, RBI will not give you money. There is a process for that. There is a documentation process. There is a verification process. It may take up to 2 to 3 days, for example, or at least 24 hours, not more than 24 hours. But now in case of marginal standing facility, what they do is that, since it is a penal rate, okay, they can borrow money within within less than one day, I can tell you, in the sense that they are always fixed at a higher rate than the repo rate, because the availability of credit or money is quicker by submitting the collateral and all. Take care. So now this MSF, they would be penal rate for banks, and the banks can borrow only by giving some securities or pledging securities within the limits of your SLR. What is SLR, guys? Right, like your CRR, cash reserve ratio. SLR is what? That is also reserve ratio. The reserves which has been kept by the commercial bank themselves. The amount of reserve which they have to keep for themselves is called as SLR. Right? Whereas CRR is the reserve has been kept by the commercial bank with the RBI. So now within the limits of SLR only, they have to go for this MSF. Clear? Any doubts? So yes, I can see, some students like, hi, who is that? Somebody called hi asking, hi, ma'am, what is penal rate? Now, penal rate is what? It is said that your marginal standing facility is a penal rate. Now, the interest rate, penal rate is nothing but the penal interest rate shall be levied at the rate of, let's say, 2% over and above the prevailing bank rate. That is that is how you say it. So now penal rate is coming under the context of MSF, as you saw now. The rate at which the banks can borrow money from RBI, guys. That too with the prescribed limit is called as penal rate. Clear? A penalty. Penal means a penalty in simple terms, I can tell you. Even more simplest penalty. Clear? That is the penal rate or penal interest rate is nothing but the type of penalty which has been levied by the loan provider. That is, if RBI is giving, means RBI will provide some sort of penalty. In the case of this, commercial banks are not paying back the money properly. For example, RBI is giving money to commercial banks. Now they say that you have to pay back the money in this point of time, but they are unable to pay the interest or the principal amount, means a penalty will be imposed on them. Clear? That is, if the interest rate is not paid, means they will be imposing on that in simple terms. Clear? That is called as penal rate. And this MSF is similar to a penal rate for whom, guys? For the is a penal rate for the commercial banks by the RBIs. Clear? Amanda, marginal standing facility you want to explain once again. Chalo, it is a new scheme, and now this scheme, I'll tell you what is MSF in simple terms. I know people are confused with repo rate and MSF. See, both are interest rate, in the sense that the rate at which the commercial banks will borrow from RBI. But now the whole point is, in case of MSF, okay, it is a new scheme introduced by RBI, point number 1. And now this scheme was introduced by RBI due to a reason. Already you have repo rate. So people may think that then why should you introduce MSF? That question goes in your brain. But now with the aim of reducing volatility, I repeat, the aim of decreasing or reducing volatility in the overnight lending rates. In where, guys? In the interbank market. And basically to ensure there is a smooth or very flexible monetary transmission in the entire financial system. For that particular purpose only, this MSF, called as marginal standing facilities, has been introduced in spite of having a repo rate. To put in more simple terms for you to understand what is MSF, I can tell you all that under this schemes. The scenario is that the banks will be able to borrow up to 2% of their respective NDTL, net demand time liabilities, from whom, guys? From the RBI. And thus, now for every bank, commercial banks, they cannot do it. Only for the scheduled commercial banks, this facility is there. There are non-scheduled and scheduled commercial banks, right? Only for the scheduled commercial banks, this facility called as marginal standing facilities available. Clear? Please note it. These are the extra points, guys, to be noted, because this will enable you to have better clarity as to what is MSF. Okay? Next thing. And what are the scheduled banks, by the way? Scheduled banks are of India. They constitute those banks which have been included in the second schedule of the Reserve Bank of India Act of 1934. Clear? Now, since February 2012, when this new scheme was introduced by RBI called as MSF, from there on, guys, from that time onwards, your bank rate, which you studied in the beginning, the interest rate, right, that was aligned or brought together with the new rate called as MSF. So currently your bank rate is in alignment with what? Is in alignment with your marginal standing facility since 2012. Clear? Now, by increasing such kind of rate, what happens? The rate at which the scheduled commercial banks are borrowing from RBI. Now, when such kind of MSF rate is increased, what happens? Whether you increase or decrease this MSF, guys, basically RBI does that to control money supply in the economy. When there is inflation or too much money supply, RBI will increase the MSF, like your repo rate, the same thing. And thus, simply you cannot, give money under this MSF, guys. There is a way for that, in the sense that since your marginal standing facility is a penal rate, the penalty rate, right? The reason is because the lending through this channel, that is the lending for commercial banks through this channel, MSF by the RBI, it has been done using an instrument called as statutory liquidity ratio, SLR. Using that, SLR securities only, they can do the lending processes. Clear? Now, do not get confused with LAF. What is LAF? liquidity adjustment facility and marginal standing facility, because LAF talks about repo rate, reverse repo rate, and MSF talks about more or less what your bank rate. It has been merged with the bank rate, and also in the context of what, in the context of your SLR, because using your saturated liquid ratio you can get it. So now the difference is that your LAF is both for the commercial and non-scheduled and non-scheduled commercial banks. Now the minimum amount, guys, the minimum or the least amount, bidding amount in your liquidity adjustment facility or repo and reverse repo rate is 5 crore. Okay, whereas in MSF it is 1 crore, because overnight you're getting it. You understand? Clear? This is the basic difference between MSF and your repo rates or reverse repo rates. Do not get confused again. And think about, and also note the point, only scheduled commercial banks can avail this facility. That is also another important keyword. Yes, Santi, when repo rate amount reached its limit, RBI closed the repo window and now issues the amount at MSF. Yes, wonderful. Yes, that's perfectly true, Santi. Did you all understand, guys, MSF very clearly? Any doubt? Shall I proceed with the next topic? And now you have to study one more thing. That is, in this context of MSF only, your saturated liquidity ratio that is coming, because MF is a penal rate. Now the meaning of that is they are a penal rate. Why guys? Because for the lending purpose, again through this MSF channel, you have to use a reserve ratio called as statutory reserve ratio. Using that security you have to go. That is why. Now, perfect. The next one, SLR. As I told you, what is that, guys? In very, very simple terms, SLR is what? SLR is nothing but the rate at which the total deposits of a bank, that is a commercial banks, which is to be maintained with itself in the form of, cash, government securities, or even gold, whatever the commercial bank is keeping with themselves. I repeat, with themselves is called as your SLR. Clear? The percentage of deposits, guys, either it can be a gold, government securities, or even your cash and all, which the commercial banks have to keep with themselves. And now it is one of the many arrows, the SLR in the RBI's monetary policy, I can tell you, because these SLR now, guys, many a times you can see them, you're getting used in isolation or in separation. That is, individually sometimes SLR is used in some scenarios by the bank, by RBI. Sometimes in a combination with other instruments you can see SLR. For example, like MSF, marginal standing facility, guys, in combination with other instruments, the RBI will use this policy tool called as SLR. Why? Because they want to manage the money supply. So individually as well as in a combination with other instruments also, SLR has been used by RBI. Now, always the SLR ratio, guys, they will be a 2-digit number. That is 18.9%, 21.5%, etc., etc. So, whereas your cash reserve ratio, they are considered to be at an ideal rate of 4%. Currently, it is 3% or 3.5, I think. So now you will be thinking that, come on, the CRR is very less compared to SLR. But though that is the case also, always RBI prefers your cash reserve ratio, guys, over your saturated liquidity ratio. Why? There is a reason for that. That is considered to be one of the most idle tool than your SLR, guys, because cash reserve ratio, commercial bank is keeping with the RBI, whereas SLR is the banks themselves, commercial bank themselves is keeping with them in the form of various securities, gold, etc., etc. Because of that particular perspective only, your CRR is more important than the SLR. Clear? Yes, Lipsy has asked a wonderful question. What makes RBI to borrow money from commercial banks? To control the liquidity, to control the certain scenarios. I will tell you, do not worry. So now, the context in which the RBI is borrowing money from commercial bank comes under reverse repo rate. That is in your LAF, liquidity adjustment facility, what you studied. Now, basically the rate of interest the RBI will pay to the client comes under your reverse repo rate, RRR. And since 1996, if you see, this reverse repo rate is a part of your liquidity adjustment facility. And now, it is a tool by which the banks, in which the surplus money is drained out, the extra money is drained out. And the banks, the commercial banks will have to park their, their surplus fund with RBI. Clear? RBI will start taking money, guys, from the market. To control the money supply, they do this scenario. Clear? And for controlling inflation. That is why they go for reverse repo rate. Is it clear, Lipsy? Yes, Sandeep? Perfect. Okay. Now, the current SLR is what it is, 18%. The meaning of that is bank has to invest 18% out of every 100 rupee deposit with him in the government securities. And now basically, again, why do you use such kind of instrument is the next question, guys. Basically, if you see the saturated liquidity ratio, they have been used by RBI to tighten or to easing of money supply, to contract or to expand the money supply in the economy according to situations. For example, there is a 50 BPS reduction in SLR. Okay. In such kind of situation, and there's a 50 BPS reduction. Now, there is more money in with the banks. So automatically what happens? Money supply increases, lending increases, investment increases. You understand? Automatically income increases, aggregate demand increases, and there will be growth. What about the opposite scenario? When there is a 50 BPS increase in SLR, everything is ulta, everything decreases. Clear? And thus over the years, if you see the two so-called instruments like your CRR and SLR, they have been in much of use by the RBI guys. And now these instruments, they have been reduced, I can say, because if you see in the year 1990, in the beginning of your economic reforms and all, it was 37 to 38%. Come on, this is too much. But currently the RBI, then they made it to 23%, then 21%, and now taking into consideration all the COVID-19 pandemic, it has become to 18%. But still it is a two-digit number, your SLR, whereas CRR is a single-digit number. That is another trick to remember. But this figure is still important to really influence what? The credit and rates. Clear? Now, this is a newspaper clipping, guys, which I brought in to show you. If you see from the current affairs perspective, this is in the context of 2019 current affairs. Okay, this month of December, Jan, that time. No, December 2019, Jan 2020, that time. The bank, they were cutting the base rate as RBI is lowering the repo rate by 25 BPS. Remember, this is very, very important. In the economy PT 365 class, which I taught in the Plus platform, very clearly I have discussed this topic. Even the YouTube also, I think in Unacademy UPSC Current Affairs channel, I have done some classes on economy 1 year current affairs. We have discussed this reducing the repo rate by 25 BPS. And RBI had their reasons for justifications as well. Clear? Now there is something called as bank base rate. Come on, you studied regarding the base rate. Sorry, the bank rate, right? Or the interest rate, or the rediscounting the bills of exchange rate, which is one of the important quantitative or traditional methods of credit control. Now you have the bank base. Look at the keyword base rate. What is that? Again, it is very, very similar to your normal bank rate or interest rate. They are also the minimum interest rate. But now the whole point is, it is a minimum interest rate, the base rate, below which it is not permissible to lend. Matlab, after a certain interest rate, minimum interest rate, for example, the minimum interest rate is 6%. Below that, you have no permission to lend. It should be 6 itself. You cannot give it below that. But there are some few exceptional cases where RBI allows them. Only in that scenario they can do. Otherwise, base rate is nothing but the minimum interest rate of a bank, below which it is not permissible to lend. It is more or less similar to what? Similar to your bank rate, but bank rate is minimum interest rate. There is no restrictions like this. Clear? And now since 2011, this concept called as base rate was introduced. That is also one of the quantitative instrument of credit control by the RBI, and now it is a benchmark, I can say, a benchmark rate for lending operations for all the banks, the commercial banks. Thus, if you see all the categories of domestic rupee loans, they should be priced only with what? I repeat, only with reference to base rate. Come on, look at this keyword. You have a keyword called as only. This comes under the extreme words of UPSC guys in your prelims examination, which I have taught you. So now with regard to base rate, yes, it is very true that they can be priced, all the categories of domestic rupee loans, only with the permission or reference of base rate you can price them. Otherwise it is not possible. And why? Why did the RBI guys, in spite of having the bank rate, in spite of having repo rate and all, why did the RBI come with this base rate? The reason is because in 2011 they wanted to introduce this, was to bring out transparency, to reduce kallatharams, or to reduce such mischiefs and frauderies, guys, and make sure that yes, everything systematic, and to bring out the transparency in the bank lending rates, and also to improve the mechanism called as what? Called as monetary transmission mechanism. Only such kind of base rate was introduced. Clear? And thus, this base rate has replaced something. What is that? They have replaced the previous benchmark. Previously, it was primary lending, rate of banks. That's the previous, base rate, guys. That previous primary lending rate has been replaced with the new one called as base rate since 2011, because that is the most because they consider it as the most effective instrument, and the banks charge this only to their trustworthy and regular customers who does not cause them any issues with regard to NPA, that is non-performing assets or bad loans. Clear? And now, why is this base rate put forward? The reason is because previously you had something called as BPLR, benchmark prime lending rate. Okay. Now, a committee was put forward in the year 2011, and they said that is under the governor, matlab under the then DY governor of RBI, Mr. Deepak Mohanty. He said, let's abolish this BPLR and go with the new transparent model called as base rate. That is how it got fixed. And even till today, if you see all the categories of the domestic rupee loans, they can be priced only with reference to what, taking into consideration the base rate. Clear? So these are the most important quantitative instruments or tools of credit control which you have to keep in mind, guys. Very, very important. Based on this, you can get static plus current affairs questions on this. Now, one more thing is there. Before going to qualitative, now let me tell you one more thing. So under the quantitative, please note it. I forgot to include that slide actually. Quantitative instruments. One more thing is there called as what? MSS. What is that? Marginal standing facility. I repeat, marginal standing facility. Ignore my handwriting. It is like that. Sorry, not marginal standing facility. Marginal stabilization scheme. Marginal stabilization scheme. That is also one of the quantitative instruments of credit control. So please note that. Okay. That is, this is something which cannot come only under monetary policy. For example, if a question comes for you in the prelims examination, that is so and so instrument, okay, is a monetary come fiscal policy. Do you think is there any instrument which is a combination of both? Do you think there could be some instruments like that? Quickly give the answers. 9:30 you have your mains class, answer writing class. Quick. If you see, yes guys, if you see in reality, the market stabilization scheme, not marginal again, the market. So I got confused with the marginal standing facility. More or less it is similar, that is why. So now there is something called as market stabilization scheme or your MSS. So now it's not completely a monetary policy, but then it's a monetary plus fiscal policy. That is fiscal cum monetary policy. You can just write it. Okay. Now, what is this basically? If it is a fiscal cum monetary policy, come on, there should be some sort of advantages. If you see a facility to control the liquidity or money supply because of what? Because or due to the excess foreign exchange flows into the country, this scheme called as market stabilization scheme is put forward. And now, how will you absorb the excess liquidity, guys? The excess liquidity or money supply will be absorbed by the RBI in the context that it will start issuing government security. And thus the interest rate for such scheme called as market stabilization scheme, that will also be paid by whom, guys? By the Ministry of Finance. Come on, note this point. Interest for such kind of schemes will be paid by the Ministry of Finance. Now, Ministry of Finance comes under what? The government side. That is why it is said that your market stabilization scheme is a fiscal cum monetary policy. Clear? And now the amount of issue and also date of issue, guys, for this particular thing has been decided by whom? The Central Bank of our country, RBI. That too, they can do that only in consultation with the Ministry of Finance, Government of India. That is why they said that your MSS, market stabilization scheme, is a fiscal cum monetary policy. Clear? Now, talking about the qualitative measures, you can just quickly go through that, what they are. Credit rationing, change in lending margin, moral suasion, direct control and all. They are just for your understanding. It is useful to know what they are. That is fixing the margin requirements. The proportion of the loan amount which is not financed by the bank. That is the part of loan which a borrower has to raise in order to get finance for his purpose. That is called as fixing margin requirements. When there is a change in margin, it simply means there is a change in loan size from big to small or from small to big. Automatically, this particular method is used to increase the money supply or credit supply, guys, for the sector that requires, be it agriculture, industry or service sector, and for all the other non-necessary sectors. Only for the priority lending sectors now this has been useful. Clear? For example, if RBI is feeling that, come on, they have to, increase more and more money in the economy, then, and they feel that, come on, you have to focus on the primary sector, is agriculture, then they have to reduce the margin. And even 85 to 90% loan can be given, guys, because they come under the PSL category. Connect this to the current affairs perspective. Priority sector lendings. Clear? The very, very important hit list topic of UPSC. Please go through. Next, you have your credit report. Consumer credit regulation. The consumer credit supply is regulated through higher purchase, installment sale of consumer goods. You will have down payment, installment amount. Matlab, you don't buy everything. Let's say, for example, you want to buy some appliances like a fridge, AC, your some other perspectives. Then you go for installment things, right? So, by giving a fixed advance and all. So, that is called as consumer credit regulations. And basically, this is help in checking the credit use and then inflation in a country. Then publicity. That is also another important method of selective credit control. Basically, through this now, various reports are published by the RBI stating what is good and bad in the entire system, what can be done. So the public gets to know, okay, this is happening. Now, such kind of information will help whom, guys? The commercial banks like State Bank and all, to direct or give credit supply in the so-called desired sectors. Okay, if agriculture is not performing proper, if industry is not performing proper, what they should do? Accordingly, they will focus on giving more and more loans to the improvement of so-called sectors. You understand? And thus, every monthly or weekly bulletins will be released. Your RB bulletin, guys, go to RB website, will get all the data, not the same thing. And everybody, you, me, anybody can access the data. That is how we get to know what is the CRR rate, what is the SLR rate. You understand? And basically, banks are using this kind of publicity or publishing the reports and data for attaining the goals of monetary policy. What are the goals of monetary policy? Point number 1 is growth with stability. Then achieving efficiency in the entire financial mechanism, etc., etc. Right? So for all these perspectives, they can use this, publicity or giving of data, etc. in the context of RBI car performance. Clear? Then credit rationing. What is rationing, guys? The central bank, they fix a credit amount to be granted, and they do that kind of rationing or rationalize that credit or money by limiting the amount variable for every commercial bank. They do that kind of ceilings and limit, and they even this method called as credit rationing, guys. They even controls the bill rediscounting. They have fixed, that is, they say that after a certain limit, let's say after 5%, you cannot do any discount. That is a maximum limit. That is called as credit rationing, which comes under the qualitative or selective credit control. Clear? Automatically, they are doing this because they do not want the money to be flowing to the unwanted or, let's say, unnecessary sectors. So basically, to prevent the money from or the bank's credit from being exposed to such unwanted sectors only, this method called as credit rationing, which is a qualitative or selective instrument of RBI monetary policy, is being used by RBI. Then moral suasion. There are so many benefits of that. That is the pressure exerted by RBI, guys, on the Indian banking system without any strict action for compliance with the rule. So moral suasion is something like a suggestion or, let's say, opinion given to the commercial banks by RBI, and they will start placing all the restrictions and restraining the credit during inflationary periods. And commercial banks will be informed then and there, guys, regarding the expectations of the central bank. What are they expecting from them through this monetary policy? So they have to perform accordingly. They will ensure a proper credit control. They will act as a backup policy tool, will help in risk mitigation, help in economic growth and development. Also very, very useful during crisis, financial crisis, and all the unforeseen emergency situations. Even during this, COVID-19 pandemic, this moral suasion is quite important because the commercial banks need that. Don't you think so? What do the central bank do is, during this moral suasion, they will give directives, guidelines, suggestions for commercial banks. Accordingly, they can manage their money supply, whether to increase or reduce or for some etc., etc. For speculative purposes, they'll reduce the credit supply. It is unnecessary, right? That is what the moral suasion do. In simple term, guidelines how a commercial bank should function based on the RBI rules and regulations to achieve the goals accordingly. Then directives, that is giving again information, the same thing. That is beyond a certain limit, do not give loans to customers also, because the problem of NPA, non-performing assets or bad loan arises. Because many commercial banks violated that only, the issues of NPA came. Your Vijay Mallya and Nirav Modi, they looted the banks, publicly the banks, and went to foreign countries and enjoying. And that is how the economic offender bill and all these act was put forward for our country, India as well. Clear? This is really affecting the poor sectors like MSME and all, because banks now generally they don't want to give money, guys, because they have the fear of now getting back the money. They were giving to all the big shots and MNC multinational corporation firms, but now for the real people who requires that, now bank is skeptical in spite of RBI telling them to give that under the context of Atmanirbhar Bharat Abhiyan, that is the 20 lakh crore economic package. Clear? I can go through all those. Then direct actions. So now we have something called as monetary policy agreement, guys. Now the time is up, I believe. So this is what we have discussed in yesterday's class. In yesterday's class, I told you regarding the monetary policy agreement. That is the MPC committee. The same thing, that is our inflation targeting. All these things we have discussed. The note is given in today's class. Okay, so please go through that and connect this with the yesterday's current affairs perspective in the editorials. That is the monetary policy committee revisions or recommendations. Please do connect it. Clear? Perfect. So thank you so much, young officers. I hope you really enjoyed the class. So that's all for today. So I hope you really enjoyed. I'll see you all at 9:30 a.m. just after 10 more minutes for the free special live class. That is top 500 mains question answers writing series. So my series is called as Munshi Premchand series. You all know Munshi Premchand, right? The greatest writer of all time. His writing was so much appreciated. So I will make you write like Munshi Premchand, guys. So do come and join for the Munshi Premchand series of UPSC mains answer writing by me at Unacademy platform daily Monday to Friday at 9:30 a.m. So quickly come and take the benefits of that. So yes, how was today's class? I hope you are very well acknowledged with the so-called monetary policy instruments as well as the current affairs perspective of that, because this theoretical understanding will enable you to have an understanding, okay, this is how the monetary policy should be, right? So bye-bye. Thank you so much, my young officers. I'll see you all very soon for the answer writing class. So till then, bye-bye. Thank you. And also make a point of putting forward all your valuable comments and feedbacks, and also make a point, whatever doubt you have, please feel free to ask. In the description box of this particular channel, you have my referral code for subscription of Unacademy Plus platform to avail my courses, and also my profile, Unacademy profile link is there. And for more details via Telegram as well, you can follow me, Nisha Nujumudeen at Unacademy for UPSC. You can even do that. And apart from that, please don't forget to like and also subscribe, and also put your comments, whatever comments you have with regard to your doubts or regard to the feedback of the class, put it. And for example, if you want to come with some tools, with some topics, do let me know via the comment box. Accordingly, in the next classes or in a special session, I will do it in this channel only, because so many people had their comments based on some topics. They wanted some extra topics to be taken. So via this Unacademy Expedition channel only, I'll be taking it. So do let me know via the comment box. Definitely, I will go with those topics as well. Clear? Perfect. Chalo, bye-bye. Thank you so much, guys. Jai Hind. And have a great day ahead. And I'll see you all now for the Unacademy free class at 9:30 a.m. Bye-bye.